I hope you and your families are safe and healthy as we all continue to manage through the challenges associated with the coronavirus pandemic. With the introduction of new vaccines and the ramp-up of their production and distribution, we are optimistic that we'll begin to see a meaningful decrease in the rate of infections and an overall slowing of new cases in the next several months. With that said, we are not in the clear yet, and the health and safety of our employees remains our top priority. As such, we are continuing to follow our rigorous safety processes and protocols across all of our sites to help ensure the well-being of our people, facilities, and communities. The safety and dedication of our employees has allowed us to maintain business continuity and to support the needs of our customers as in-market demand for aluminum products returns to pre-pandemic levels. At this time, all of our plants are operational and running at near capacity levels. As a result of our employees' hard work, our expanded global presence, and favorable market conditions, we delivered another record quarter of adjusted Ebitda, including a record organic growth even before the addition of the acquired business. Much of this improvement is attributed to the recovery in the automotive markets, the building and construction markets, as well as other specialty markets, and very strong demand in the global beverage can market. While the markets are providing strong tailwinds, our work over the past many years to strengthen our operations, coupled with the ongoing and successful integration of Aleris into our global footprint, is driving synergies and positively moving the needle on our financial targets and metrics, including the rapid reduction in net leverage. We entered the fiscal year in a position of financial and operational strength, prioritizing capital spend toward our strategic growth initiatives and sustaining CapEx to protect and enhance our operations today, while continuing to position ourselves to expand and grow for the future. To that end, the commissioning process at our newest automotive finishing lines in the U.S. and China, as well as our expansion in Brazil to support the beverage can business, continue to make great progress. And we are investing not only in new capacity, but also in research and development, new technologies, and exciting innovative partnerships to drive the continued adoption of sustainable aluminum solutions in markets and lead the now for in-market, providing more view of the product in markets on slide 4. Broadly speaking, we believe the positive global demand trajectory for aluminum products will not be impacted by COVID long term. These associated across waste, not only is it infinitely recyclable material, continue to drive long-term global demand for aluminum FRP of approximately 5%. Similarly, with the exception of aerospace, our short-term one-year outlook across end markets remains positive, and we work closely with our customers to assess production of their sales. Revenue mix, beverage continues to economic. Asia has faced some more challenges in 2020, mainly related to the reduced tourism and lockdowns in the region. But this is being partially offset by higher Middle East can production for export to North America, where can making capacity in the U.S. is tight as we await recently announced capacity additions to come online. But it's not just North America that plans to expand can making capacity. There have been numerous expansion announcements from can makers across all regions where we operate expected over the next 2 to 3 years. In South America, the premium associated with beer in cans and a shift towards off-premise consumption has driven the share of aluminum cans as a package type for beer to approximately 58% compared to about 52% last year. And this package mix shift is not just in beer. New beverage categories such as sparkling water, spiked seltzer, and energy drinks are increasingly being released in a wide variety of aluminum packaging. While market demand for beverage can sheet is forecasted to grow approximately 6%, Novelis is already operating near its upper limits of capacity. Turning to automotive, a heightened OEM focus on sustainability and adoption of electric vehicles by consumers is supporting increased demand for aluminum. The recent research we've seen suggests that the pandemic has triggered the desire for safer personal mobility, and the shift toward vehicle types which use a higher share of aluminum, such as SUVs, trucks, and electric vehicles, have proven resilient. The North America automotive market is recovering toward pre-COVID levels, but with an unprecedented high share of SUVs and pickup trucks in the overall vehicle production mix. The discontinuation of some European government incentives and lockdown restrictions may have some near-term impact on demand in Europe, but broadly, consumer preference is shifting to EVs and mid-premium cars with more and more aluminum structures and components. Meanwhile, the automotive market in China has experienced a V-shaped rebound, with further aluminum demand tailwinds from government incentives and consumer pull for SUVs, EVs, and premium vehicles. Specific to Novelis, the success of key customer launches has driven a strong order book, and we are excited to work with our customers as we ramp up our new automotive finishing lines over the next several months. Moving to Specialties, our second largest segment by revenue with the addition of Aleris. Customer demand for many markets are at or near pre-pandemic levels, particularly in North America. Building and construction demand is very high, supported by favorable housing fundamentals such as new home builds in the U.S. and home renovations in Europe. Meanwhile, the transportation segment is growing from increased aluminum adoption in commercial trucks and trailers and general market recovery. Elsewhere, demand for painted products, consumer electronics, and container full packaging remains high, and the recovery in broader automotive markets is leading to a stronger demand for heat exchanger material. Lastly, demand for premium aeroplate from OEMs is expected to remain muted through the first half of this year due to lower consumer air travel, with some potential for growth later in the year. Turning to slide 5, capturing this strong market performance would not be achievable if not for the successful implementation of world-class manufacturing strategies and digital technologies to improve operational and recycling performance. Several years ago, Novelis implemented a balanced approach to support its operations, prioritizing safety while applying a back-to-basics mentality toward manufacturing excellence and improving return on capital employed. This included strict adherence to preventive maintenance at the plants in order to reduce unplanned downtime, as well as improve operational efficiency, product quality, and recovery. We also continue to strive to be the partner of choice for our customers, delivering high recycled content products and services that meet their demanding standards for quality and on-time delivery, while working alongside them to innovate next-generation solutions at our state-of-the-art customer solution centers around the world. Since rolling out our balanced scorecard in fiscal 2016, we have driven fantastic improvements across our key metrics at our legacy Novelis plants. I'd like to mention a few examples that we're particularly proud of. Customer satisfaction scores are up 24% as a result of deepening our relationships across business segments. Quality improved with a 73% reduction in parts per million defects, while recovery rates in the manufacturing process for canned body stock are up 4% and up 10% in automotive. This progress translates to less runaround scrap, fewer claims, and more efficiencies to lower cost, while increased capacity, better quality, and reliability have led to higher sales and stronger customer partnerships. Looking forward, we will continue to leverage our long-standing expertise and successes as we ramp up not only our acquired assets, but also our newest facilities as well. And we will also be guided by our purpose to shape a sustainable world together. As the world's largest recycler of aluminum, sustainability has always been at the heart of who we are and will continue to guide our strategic decision-making as well as our investments to grow our business moving forward. Over the last decade, Novelis has increased the recycled content of its product by 26 percentage points, from 33% in fiscal 2010 to 59% in fiscal 20. We have also made great progress across a range of metrics, including greenhouse gas emissions, waste to landfill, water usage, and energy intensity. And with our recent acquisition of Aleris, we are currently in the process of evaluating the right framework and standards to adopt to make further strides towards reducing our carbon footprint and promoting a more circular economy. Moving to our expansion projects on slide 7, we have made excellent progress on their construction and commissioning. In December, our Greenfield U.S. Automotive finishing line in Guthrie, Kentucky, celebrated a major milestone when the facility shipped its first production coils to a qualified customer. Guthrie is a 200 KT finishing plant with both pretreatment and heat treatment capabilities, designed to be one of the most efficient auto body sheet plants in the world. Meanwhile, with very strong demand in China, we are working with key customers to accelerate qualification at our new 100 KT finishing line in Changzhou. Customer qualification is currently underway, with our first commercial shipments expected to begin at the end of this fiscal year. Lastly, our casting, rolling, and recycling expansion in Brazil to support our can business continues to progress extremely well, with a targeted startup in early to mid-fiscal 2022. Our strategic growth initiatives are not limited to investments in capacity, but also include investments in innovation and technologies that are driving business growth. We are bringing new alloys to market and entering new partnerships to meet the most technically sophisticated needs of our customers and move the industry forward. For example, in line with our purpose of shaping a sustainable world together, we are offering an increased number of high recycled content alloys for use in specialty end markets, from coffee capsules to cosmetics packaging, where we see increased demand for more sustainable solutions. In Europe, we recently launched an unmatched pre-anodized product available for exterior and interior building facades with an alloy comprised of 90% recycled content. And in the coming weeks, we'll hear more about a new high-strength, lightweight alloy for the automotive market that will continue to differentiate Novelis from its competitors. Increasing the adoption of aluminum in the automotive market is an endeavor that benefits the entire aluminum industry and supply chain. To that end, last week we announced Alumobility, a newly created ecosystem of leading aluminum and downstream technology partners that will focus on implementation-ready technological solutions to advance the adoption of aluminum automotive body sheet. Alumobility will help further develop smarter, lighter, safer, and more sustainable vehicles and provide innovative solutions that drive value for automakers and consumers and help fulfill the promise of a more sustainable mobility future. And now I'd like to turn the call over to Dev for a more detailed review of our financial results.
Thank you, Steve, and good morning or good evening. As a reminder, with the Aleris acquisition completed in April, The contribution of the Aleris assets from April 14 onward are reflected in our fiscal 2021 results from continuing operations. Results related to the Lewisport and Duffel plants are reflected as discontinued operations. We reported net income attributable to our common shareholder of $176 million in the third quarter of fiscal 2021. Net income from continuing operations was up 82% versus the prior year to $195 million. Excluding tax-affected special items as outlined in the back of today's earnings press release, net income from continuing operations increased 58% to a record high $209 million. This is primarily driven by higher after-tax adjusted Ebitda, partially offset by higher depreciation and amortization, mainly associated with the acquired business. Adjusted Ebitda increased 46% versus the prior year to $501 million, driven by record organic Ebitda generation, including a favorable $25 million customer contractual obligation, as well as a $50 million Ebitda contribution from the acquired Aleris business. Consolidated company Ebitda per ton also reached a new record high at $537 per ton in the third quarter. Net sales increased 19% versus the prior year to $3.2 billion. The increase is mainly due to higher total shipments and slightly higher average aluminum prices. Total flat-rolled product shipments increased 17% to 933 kilotons, including 104 KT contribution from the acquired Aleris business and higher shipments across all end markets. Turning to slide 11 and the Ebitda bridge, the vast majority of the improvement in Ebitda stems from higher volume, lower can and specialties pricing, and regional automotive mix is mostly offset by a favorable $25 million year-to-date customer contractual obligation booked in the third quarter. Favorable metal costs as well as continued focus on operating and SG&A cost control and initial synergy savings mitigated the impact of the higher cost base related to the acquisition and some long-term incentive-related costs in SG&A. Lastly, foreign exchange was a positive versus the prior year due to favorable translation in Europe due to the stronger euro and a favorable US to Korean won hedged rate on cash flow compared to the prior year. Let's turn to slide 12, and I'll provide a little more detail on Q3 performance by segment. Starting with North America, total FRP shipments increased 29% year over year, and segment income or adjusted Ebitda for the region increased by 62%. This is mainly due to the addition of the acquired building and construction and other specialties businesses in the current year. In addition, can shipments grew driven by high at-home consumption, while automotive shipments were down versus the prior year due to a major customer vehicle model changeover during the quarter. This was a temporary factor, and we anticipate a return to strong automotive shipments in the fourth quarter. Favorable metal costs continue to be a benefit, but we do see some signs of this lessening as scrap availability and global metal flow changes as China has reopened high-grade secondary alloy imports of high purity. And while specialties pricing was down compared to the prior year on increased competition from suppliers outside of China, market pricing has turned more favorable for calendar 2021 with the implementation of new anti-dumping duties on imported common alloy aluminum sheet. Europe saw a 13% increase in shipments and an Ebitda that more than doubled. Results were driven by several positive factors, including the addition of the acquired heat exchanger, aerospace, and commercial plate business, a stronger can market, and interregional support to meet strong demand for automotive sheet in China. This quarter also benefited from favorable metal mix and currency translation from the euro to US dollar, as well as a $25 million year-to-date customer contractual obligation booked in Q3. Turning to slide 13, our Asia segment increased shipments by 6% and Ebitda by 42%, driven primarily by record automotive shipments on very strong local demand driving volume and mix benefits. The increase in Ebitda is also due to the contribution from the acquired aerospace and commercial plate business and favorable foreign exchange impacts, partially offset by higher freight costs due to constrained ocean vessel availability across Asia. Lastly, South America shipments grew 8% and Ebitda 11%. This is entirely organic growth due to strong market demand for beverage can sheet from accelerated packaging mix conversion to aluminum and record production levels at our Pinda plant in Brazil, as well as favorable metal costs. These factors are partially offset by lower can pricing due mainly to prior year deflationary cost pass-throughs and a prior year favorable credit litigation settlement not recurring in the current year. Moving to slide 14. So captured in our results for the quarter and year to date are the initial combination synergy savings from the Aleris acquisition. At the end of November, we closed the sale of the Lewisport auto body sheet business to American Industrial Partners, a private equity firm, for a net cash proceeds of $180 million. We previously closed the sale of Duffel, receiving 210 million euro of the agreed 310 million euro purchase price in the second quarter. Arbitration is underway to collect the remaining 100 million euro. With these divestments now behind us, we have sharpened our focus on integrating the acquired continuing operations and capturing over 180 million in total synergies. Last quarter, we raised our estimate for combination synergy savings expectations to approximately 120 million, significantly higher than the roughly 85 million in cost reduction opportunities originally estimated at the time of acquisition announcement. Not only have we uncovered greater synergy opportunities, we are achieving them even faster than expected. Through the end of the third quarter, we have already achieved 54 million in run rate savings, or roughly 45% of the increased synergy forecast. These savings stem primarily from combination savings in general management, procurement, finance, IT, and other general and administrative buckets. We estimate we can achieve an additional 65 million in transformational synergies by integrating our business in China. This is a result of creating efficiencies with scrap consumption and cost savings from the elimination of import duties and significantly reduced transportation costs. In addition, this releases capacity in our Korean rolling mills, providing flexibility and optionality to capture new market opportunities. The engineering and land study associated with the coal mill investment in China, which we initially estimated at approximately $300 million in capital expenditures, is underway. We aim to begin construction in mid-fiscal 2022. Now let's turn to free cash flow on slide 15. On a year-to-date basis, an 11% increase in Ebitda and a 23% decrease in capital expenditures have led to significant free cash flow from continuing operations of 331 million as compared to $61 million in fiscal year 20. Capital expenditures are down versus the prior year as spending is prioritized to support maintenance activities and the strategic expansion projects underway that Steve talked about earlier. We continue to anticipate full year fiscal 2021 capital spending to be in the range of $450 to $500 million, including the addition of sustaining capital expenditures for the acquired Aleris business. As is clear from the year-to-date performance, we expect to deliver a very strong positive free cash flow from continuing operations for the full fiscal year 2021. With a strong cash balance and confidence in free cash flow generation, we reduced a portion of the short-term bridge loan due April 2022 by $500 million in the quarter. Combined debt reduction and increased Ebitda drove a rapid improvement in net leverage to 3.3 in December, a 50 basis points improvement from just 8 months ago at the time of acquisition close. We now expect we will achieve our targeted net leverage ratio of below 3x much earlier than the end of fiscal year 2022 as previously guided. We also continue to maintain ample liquidity levels, ending the quarter with $2.4 billion, providing us the financial flexibility to act quickly to customer demand and continue to prioritize strategic capital projects for long-term growth. I'd now like to turn the call back over to Steve.
Thanks, Dev. Let me give a brief summary before we turn it over to you for your questions. Our strong customer relationships, diversified portfolio, outstanding operational performance, and expanded global presence with the addition of Alaris have all contributed to another record quarter. We are capturing near and long-term favorable demand trends for aluminum FRP across end markets by leveraging the flexibility of our diverse global footprint and product portfolio and capturing value through the acquisition synergies. We are also making excellent progress on our strategic growth initiatives to drive long-term value by investing in new capacity and technology, entering new partnerships to solidify aluminum as a material choice for our customers, and bringing new alloys to market that will drive the industry forward and grow our business in the near term and long term. With that, Dev and I are happy to take any questions you might have.
If you would like to register a question, please press the 1 followed by the 4 on your telephone. You will hear a 3-tone prompt to acknowledge your request. If your question has been answered and you would like to withdraw your registration, please press the 1 followed by the 3. Our first question comes from the line of Matthew Fields from Bank of America. Your line is open.
Hey, everyone. Happy New Year. Hope you're all well. First, I wanted to ask about South America. The segment just sort of keeps performing better and better. It looks like you have sort of record Ebitda, record tons, despite the Pinda expansion not being done yet. So I just is that 158 KT production level kind of sustainable? Is that above capacity technically? How should we think about this before the 100 KT of expansion comes online next year?
Thank you for the question, Matthew, and Happy New Year to you as well. So to the question about South America. So first, what is happening on the macro side in South America is that the pandemic has resulted in an acceleration of shift of packaging from glass bottles towards can in the beer segment. So it's not like a beverage consumption or beer consumption is going up year on year. And we are getting the benefit of the accelerated packaging shift. Now, really, in the initial months of the pandemic, i.e., the June quarter, the later part of June quarter and part of the July-September quarter, we saw a big surge. It kind of came back a little, but broadly, we expect that some of this will stick. Some of the quick shift will stick. So we feel overall very good about the South American business. As far as your point about the volumes and are they, sort of at sustainable capacity, yes. I mean, there is nothing in the volumes from a capacity standpoint that is unsustainable. And actually, we are a bit above our theoretically rated capacity because of all the work that we have put in on world-class manufacturing, on some little bit of debottlenecking, and driving a lot of productivity initiatives. So we are very proud actually, of all the benefits that we are getting by investing in a number of productivity initiatives. So we are sort of very keenly awaiting the expansion because we continue to feel good about the market in future. And overall, as I said, the only thing is that some of this quick shift of packaging may kind of come back, but compared to pre-pandemic levels, a part of that will stick, and that's what makes us feel good, in short.
Okay, that's very helpful. Thank you. And then, you've done a good job sort of driving the debt down post the acquisition, kind of about 40% secured, 60% unsecured right now. What's your sort of overall thinking about balance between secured and unsecured, kind of when you hit that 3x net debt target?
Right. So Matthew, as we speak, we are working on that. And we will be articulating it in some more detail in not too long a time from now. But let me tell you the direction of the thinking on the overall debt. So first is that we had told you earlier that we will be basically replacing the bridge for a part by unsecured debt largely, so replacing unsecured with unsecured. Now we are telling you that we may not need to raise any money to repay the entire bridge loan. We have repaid we have repaid 500 million out of the 1,100 million, and the balance also we will be repaying sooner than later from internal cash generation. So that is one piece. The other piece is that the next action on our side will be the term loan debt, the secured floating rate term loan debt maturing in June 2022. Again, we had earlier said we'll replace secured with secured and unsecured with unsecured. Now, just looking at the way the markets are, and given how attractive it is to raise secured debt, we may actually replace a part of the term loan with unsecured debt, a part of the term loan with unsecured debt, and some part with secured debt. So that will be the next milestone. And as I said, we'll come back with our clear strategy soon. So directionally, what we will do is we will take a bit of a cut in our secured debt portion towards unsecured debt, just because that's really the right thing to do based upon where the markets are. And then the next milestone will be really the 26 notes, where the window opens up in September. It's a bit early to comment on that. Opportunistically, we'll think about that, as we go forward. So overall, in short, if I just tell you what we are doing, we will de-level much more rapidly as compared to what we were indicating earlier, and go below 3 much quicker. And we will raise some more unsecured than we had thought earlier, just based upon things as we see it now.
All right, great. That's really clear and very helpful. And with your 2030s trading below 4%, I think the market would be very accommodative. So thanks very much, and good luck.
Thank you, Matthew.
The next question comes from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, thanks for the chance, and congratulations on good results, and also very useful color in the presentation on segmental regions performance. First question is, Steve, you mentioned that the new can capacity is coming. Just want to understand what sort of margin tailwinds are we witnessing in can contract renewals, and also how long will this tailwind continue till we renegotiate or rebase all our legacy contracts?
All right. Yeah. So the overall, as we talked about in our prepared remarks, the overall can market on a global basis is growing at a great pace because of all the sustainability trends we've talked about at home consumption during COVID, and we're very confident in that continued growth. Different for each region. I think North America, we will see something around 2 to 3% annual growth through 2025. as you've seen many can lines being announced in the North American marketplace. And we're keen to continue to serve our customers there with finding ways to debottleneck and grow with our customers. Same in Europe. We think growth there is going to be in the range of 3 to 4% in that kind of period. A little bit more near-term softness, probably even going into the summer tourism period again in Europe, but overall good fundamentals. Dev just talked about Brazil and the market there, so I won't repeat his comments. And Asia continues to grow broadly at around 5%, we look to find places where our pricing can be leveraged for quality. So overall, from a contract pricing standpoint, our contracts, are come up on a periodic basis, so it's hard to get into individual time frames because they're just continually rotating and being renegotiated. We do feel comfortable with the trend of with this tight market conditions, even with the addition of the Arconic capacity coming on in North America, that we still will see pricing trends favorable to can sheet providers in the near and medium term future.
I understand. My follow-up question is, the opening remarks you did mention that there are two things at play in North America. One is the tariffs and the other is the new scrap policy in China. Is it possible to share some more color on both these parameters, and also where do you see scrap prices going because of this new policy? They have, structurally reduced from 80% to 60% of P1020. Now, with this new policy, do we see this going back to the historical high levels?
Yes. Sumangal, let me take this question. So let me start by talking about tariffs. So here is what is happening. We have recently got an indicator in October. There were some preliminary announcements also on the light gauge side, and the final notifications would be coming in the coming months. So basically, we see some help coming on the pricing side because of all the anti-dumping duties. It is going to create some pricing improvements. On the specialty side, it's already happening, not anything futuristic. We are seeing some pricing upsides coming from all the anti-dumping duties. So that is a helpful direction. And this is not going to change very soon under the new administration. These duties are going to be there for a 4 to 5 year time frame. So that's net positive for North America. On the scrap policy, so we are watching very closely. It's a bit early to make any final comments on this. So China has reduced or rather removed any quotas on high purity grade imports, which is encouraging reprocessing of scrap into high purity alloys and ingots for exporting to China. Now, in principle, that is something that can tighten markets, but it's a bit premature to comment as to how sustainable that is going to be, and are there going to be any change of dynamics here, either from China or otherwise. We are watching that space. We are seeing some tightness in markets, but the tightness in markets is a combination of what I just said, but also a lot of logistical challenges across the world. We have tightness in the freight market in China due to lack of container and vessel availability. We are seeing logistical tightness due to the COVID environment in North America. So availability of transport is a bit tight. Besides the fact that, we see a tightening spread because of demand in the continuous cast segment in particular, a little bit on the UBC side. So we are seeing tightness for that reason as well. So it's a bit difficult right now to make any final comments. We are watching the trends. That is as far as the scrap is concerned. Was there something else, Sumangal, that you wanted to know besides these two?
No, I just have one separate question, the last one. As we are ramping up a new auto line in US, what is the hot mill feed here? Is it a shift from specialty feed or also some shift from canned sheet feed as well?
Listen, we're committed to all of our end market customers, and we're doing everything we can to debottleneck. We talked a lot about the various operational efficiencies that we've been able to drive over the last 5 years, and we continue to do that. And continue to want to participate in many of the specialty markets, and the can market is very key to us, as well as growing in the auto market. And that's a mix that we're going to have to work through. And obviously, in nearer times, there might be some prioritization on some of our specialty products. But ultimately, you should not think of it as substitution, but us trying to find a way to grow with the market, all of our markets.
Got it. Thanks a lot, Dev and Steve. Good luck.
Thank you.
Thank you.
Our next question comes from the line of Pinakan Parekh from JP Morgan. Your line is open.
Sure. Thank you very much. I have two questions. My first question is, when we look at the leverage ratio, right, if you look at the adjusted Ebitda for the last 2 quarters, it is running at near $2 billion on an annualized basis, and hence the company is already below 3x if we were to take the current numbers. In that context, is Novelis looking, what is the kind of the capital structure that the Novelis is looking over the next 12 months? Would it be happy to go below 3x, near 2.5x, or should we see new spending come up, which would basically stabilize the leverage ratio at around 3x? And my second question is that if we look at the margins adjusted Ebitda per ton, it has been near $500 per ton. That was what the guidance was. Would this margins come under the guidance and the margins come under pressure if the scrap markets were to tighten materially, or does this already bake in some kind of tightness in the scrap markets going forward?
Okay, Pinakin, thanks for the question. And first, let me address the leverage question that you asked. So we will go well below 3x in the next many quarters. We see the delevering happening pretty quickly. And what we're trying to do is, remember where we exited last year, just before the acquisition of Aleris, we exited at about, like 2.1 or thereabouts, 2.1, 2.2. So what we are trying to do now is really get the balance sheet strengthened again. So we will go below 3, perhaps or even below 2.5. And that really gives us a lot of, as I keep saying, lot of dry powder, to be able to do everything that we need to do to drive future growth opportunities. Now, we'll come to you more specifically on capital allocation, hopefully in the next many weeks. We are getting ready to articulate that. But at this moment, I'll just say that we will see some delevering well below levels of 3. That's what I can tell you. Now, let's go to the second question on the EBITDA per ton. So last time we told you 470 to 500. Overall, we are feeling good about the business, and I would stay with that guidance. We still have unknowns to deal with, and therefore, although we have already gone over 500, we would still like to get more confidence, So I would stick to the same guidance as we gave earlier, also for the reason you mentioned, we do see volatility on the scrap side. COVID is not yet over, so that's really how I would how I would come back on your question.
Understood. This is very helpful. Thank you very much.
The next question comes from the line of Carl Blunnen from Goldman Sachs. Your line is open.
Hi, good morning. Congrats on the strong results this quarter. I just wanted to ask a couple questions. First, on North America Automotive, is there a way to quantify the impact to your earnings from the customer vehicle model changeover, and how long you expect that to impact results?
Yeah, I assume you're speaking of the F-150. And so I think when you take a look at Ford's reported Q4 F-Series They were down, I think, approximately 15%, impacted by the lower F-150 inventories from some lingering effects of the Q2 coronavirus production stoppage, leading up to the all-new F-150 transition itself. We saw some lumpiness from the changeover in our fiscal third quarter, but really anticipate strong fourth quarter for demand across Ford and other customers in that region. So any impact is, really in the rearview mirror at this point of time as it relates to the changeover, and looking forward to a strong fourth quarter.
That's helpful. Just with regard to spending going forward, you mentioned the engineering study underway in China for the cold mill. Could you remind us what size that type of investment could be, or the ranges that you could consider, also the cadence?
Yeah, so we're finishing up the engineering study, and we'd expect to complete that in late March, April timeframe, which will give us a much more specific roadmap to the project as well as the cost of the project. Right now, we're in the range of somewhere in 275 to 325 is kind of our view of cost associated with the expansion and integration with Chungju. So excited to get the engineering study and excited to get moving on the project itself.
And then Dev outlined some capital allocation goals, and that there'll be some more clarity coming once the leverage moves down beyond your initial target. I'd be interested, where does, you have a lot of growth opportunities too, but where would a cash return to the parent sit for the priorities for the company?
Yeah, Carl, at this point, I would just ask you to hold that question because we are very actively discussing the capital allocation policy going forward, just given that, we feel very good about the balance sheet as we look ahead. So I would just request that you hold this question and we commit to come back with a complete answer on all capital allocation related questions.
Understood. Thanks very much.
Thank you.
As a reminder, to queue for a question, please press the 1 followed by the 4. Our next question comes from the line of Amit Dixit from Edelweiss Singapore. Your line is open.
Yeah, hi. Congratulations for a good set of numbers. I have two questions. The first one relates to the in Ebitda bridge, there you will be 17 million negative owing to higher FGA and, of course, other factors from acquired business. Now, since we have synergies that are up and running, and in fact they are running faster than what we have observed, what we could have assumed earlier. So, do you expect this number to go down significantly going ahead? That is first question.
Yeah. So, Amit, we have to be careful about these cost numbers when you look at them one quarter at a time, because there is always noise within quarters. So we did a true up of some costs primarily related to employee costs in this quarter from incentives, and that is why you see a good part of the 17 million coming from that. Let me tell you this. We are on an underlying basis because the cost numbers of the quarter and the 9 months, when you compare them to prior periods, have the effect of LRS in them. So, they are a bit noisy. On a real underlying basis, we are managing to keep costs flat on much higher volume. So that should tell you that we are doing a good job on cost discipline. So really, we feel good. The 17 million is a bit of quarterly noise, and you should not read too much into it.
Okay, that's reassuring. The second question is essentially on aluminum scrap spread. How did you see aluminum scrap spread for you in Q3? And how do you see spot spread now? I mean, you can give a trend, whether you see it higher, lower, or a similar number?
We feel generally okay about the spreads. Spreads are tightening, particularly on the lower grade scraps, which go into the continuous cast market. We see some tightening. as I was alluding to earlier, that there is some tightness also coming because of logistical issues, because of supply chain in the scrap market. We are watching that very closely. So there are some reasons for some tightening in the scrap market. And remember, we have our own recycling capacity getting expanded in South America. So we do see some reasons for tightness. For Q3, we feel good. The numbers were good. We don't expect that, at least in the near future, to be any major negative swing. Certainly something to keep watching is how I would say.
Okay, great. Wonderful. Thank you and all the best.
Thank you.
Thank you.
The next question comes from the line of Satyadeep Jain from Ambit. Your line is open.
Hi, good morning. Thank you for taking the question. Couple of questions on the recycling. One of your customers had recently indicated more lobbying for more deposit laws in the U.S. Just to encourage more public recycling. Where are you guys positioned in terms of lobbying for that effort? And do you see any significant progress for more deposit laws in U.S. in the maybe coming year or so?
Yeah. So as the world's leader in recycling, we do think we have a strong voice here, and we need to lean into this because one of the biggest issues is associated with ability to get recycled content. And the U.S. is a great example where you see recycling rates actually decreasing over the historical averages. I think last year around 46% recycled used beverage cans. And so as we think about how to make our voice heard, we want to do it intentionally. That will drive up recycled rates inside of any jurisdiction around the world. And as you look at deposit legislation in states of which that already have deposit legislation, you see higher recycle rates. And so I think not knowing specifically where the pushes are going to be, but generally deposit legislation seems to drive higher recycle rates, and I think that's the key that we'll make sure our voice is heard to support.
Okay, thank you. On Guthrie, how much is the volume contracted as of now, and what's your directionally? Can you indicate whether the contracts for Guthrie would be relatively higher than or lower than what you saw for the other automotive contracts? And also, given the change in administration and stuff, are you seeing any momentum towards somebody else also looking at full automotive body vehicle? Any conversations you've had with your customers on that?
Yeah, sure. So I'll start with Guthrie. As we said in our prepared remarks, we shipped our first commercial coil in December. We're moving as quickly as possible because of the strong demand in the marketplace. We're contracting well within or ahead of what we expected on that facility, and that facility will be fully utilized within a 3-year period because of the growth in the market itself. I'm not going to get into the contracts, but overall, very healthy pricing continues. Because of the attributes of which aluminum can bring to our customers and auto OEMs, whether it be for fuel efficiency or lightweighting for other purposes, electric vehicle ranges and other content coming onto vehicles. As far as the new administration, obviously there'll be relooks at CAFE fuel efficiency standards, but I think you already see it from the customers moving towards regulation that California was already setting, announcing, I think last week, GM, that they'll have their entire fleet be electric vehicles by 2035. And as we've seen, as fuel efficiency standards are met, not necessarily always by regulation, but for the right reasons for corporations and sustainability trends, as electric vehicles move into the marketplace, these are all areas of which aluminum can provide significant sustainable solutions to OEMs and will drive continued growth in the automotive sheet, aluminum automotive sheet business into the future.
Okay, thank you. Just one more, if I may. On the capital allocation part, you discussed, I think we'll probably get more details over time. But if you achieve your leverage target sooner than you earlier anticipated, I know we have the China coal mill and some debottlenecking projects also in pipeline, but is there a potential, let's say a few years down the line, 2-3 years down the line, for a hot mill expansion, a new greenfield hot mill in Novelis portfolio? And if you were to look at any hot mill expansion, any idea which region would you incline towards if you look at expansion?
Yeah, it's a great question, and we see a lot of opportunities for growth as we look at our in markets and the growth and why it's growing. As I just talked about auto, we've talked about aluminum as an infinitely recyclable package that's is truly a circular economy. It comes back and it's in 60 days if we can get it back made into another can over and over and over, which is very different than other packaging materials. So there's a lot of really positive trends that we see that's going to grow overall aluminum FRP market, and we're going to be there working with our customers to find the right opportunities. And it's just too early to talk about specifics more than that, but we're very encouraged with continued growth over the next several years, 5 to 10 year period.
Thank you, guys.
Thanks.
Our last question comes from the line of Vishal Chandak from MK Global. Your line is open.
Yeah, thanks for taking my question and congratulations on a very good set of numbers. My first question was with respect to how, with the expansion of your US and Chinese automotive facilities, how do you see a shift between overall mix between cans and autos?
Yeah, so as I said earlier, we continue to find ways, as we have over the last 5 years, to continue to get more and more out of our manufacturing systems, out of our hot mills and our cold mills. We've had a lot of success increasing recovery rates in can body by 4% over that period and auto by 10%. We continue to take out defects, and all this just makes us more efficient to continue to grow with all of our customer base. And we certainly want to do that and continue to support them. And we're going to find ways to do deep bottlenecking projects and other things that will continue to allow us to support our specialties businesses, our can business, and grow our auto business as well with the new commissioning of both the China line and the U.S. line. Obviously there could be some shorter term, implications, but the trend that I want to leave with you is that we're looking to find ways to support all of our customers in their growth.
Sure. Just a second question was with respect to the scrap again. What percentage of your scrap procurement would be in the spot and how much would be generally in contracts? And given the fact that the consumption of aluminum beverage cans has increased during the pandemic times, and so would have been the availability of the spot scraps as well. So do you see a change in the mix going forward in this entire scheme, and also that getting reflected in increased recycling content in your overall production? Thanks.
Okay, so I don't think there's one simple straight answer to spot versus contracted, because markets behave differently. We act based upon market opportunities. But let me give you a slightly broader answer. So we do lock in spread margins, which then sort of leave the metal piece to fluctuate. For example, in the North American market largely. And so therefore it's not spot. I mean, we keep locking in spreads for many months ahead. In South America also, we do something very similar, and we have a very, very efficient scrap collection cycle there. It's an extremely very well developed scrap market. So things move in a generally very predictable way. And so, largely, what I can tell you is that it's not like we do a lot of spot activity. We do have generally good visibility on our spread. The metal piece is the one that keeps going up and down. So that is largely how things go. And will the current situation lead to any change in behavior? No, not really. I think that we will continue to do what we do. We'll deal with all the short-term tightness. Hopefully short-term tightness is what we see. We will do the right thing. We will continue to deal with it. We don't see any reason to trigger any changes in our behavior on how we buy scrap in short.
Sure, that's helpful. Thank you so much.
Thank you.
Mr. Fisher, there are no further questions at this time. I will now turn the call back to you. Please continue with your presentation or closing remarks.
Great, thank you, and thank everyone for your time today, and wishing you all remain safe and healthy. I also want to take just a minute to thank my colleagues for their commitment to safely serving our customers and delivering just an absolutely outstanding quarter. As we've said, looking forward, we are confident in our ability to continue to deliver industry-leading sustainable aluminum solutions to our customers and expand and grow for the future and ultimately create value for all of our stakeholders. So again, thank you and look forward to talking to you again soon.